Exploding debt is a real worry if you're an investor. Debt is piling up. The music stops when you get a major crisis. The big question is, at what point does the bond market break? The most powerful weapon in China's arsenal, selling US treasuries. In total, America now owes over $33 trillion. That's more than the economies of Europe, Africa, and South America combined. If it wasn't already a problem, then after the last few months, it definitely is. For nearly a century, the United States was the most stable economy in the world. Friends and rivals alike bought their debt, using it to secure their pension funds, sovereign wealth funds, and even their own currencies, because the whole system was based on one assumption: the dollar would never fail. But what if that suddenly changed? Since 2008, US debt has tripled. Every year, America needs to pay over $1 trillion just to cover its existing loans. And year after year, each new budget piles on more and more. Now for the first time in decades, people have begun to ask, can the US actually afford all of this debt? Since 2021, China, formerly the world's biggest holder of American debt, has sold over $340 billion worth of US bonds. And it's not just them. Japan, Britain, Germany, America's long-standing allies are trying to sell too. And just when it looked like things couldn't get worse, a new round of tariffs has sent global markets into turmoil. America is no longer the predictable, secure economy it once was. And although by no means is it about to collapse, if it stumbles under the weight of its debt, it won't just hurt Americans. It could bring the entire global economy to its knees. America's future as the world's leading economy has suddenly been brought into question. But there was once a time where even doubting the safety of US debt would have seemed absurd. That's because for nearly the last 100 years, the United States has been the bank of the world. Whenever they needed money, all they had to do was issue debt. And almost every major country around the world would be queuing to take it. Japan, China, and the United Kingdom all hold hundreds of billions of dollars of US debt, entrusting their savings to the US government. For them, this is kind of like an investment. The US government pays them on average 2% back every year, which compared to the return on US stocks may seem like nothing. But there is a difference. While companies may and often do go bust, a country is far less likely to. Pension funds, sovereign wealth funds, and all government savings operate with taxpayer money. Money governments can't afford to lose. So when it comes to safety, nothing has beaten US debt as it is underpinned by the United States. But there is a problem to this. This mutual trust only works when you know you're going to be paid back. There's an old saying that if the bank lends you $100, it's your problem. But if they lend you $1 million, it's the bank's problem. The US now owes $33 trillion, which makes it everyone's problem. Things began to change in 2008. The US economy had just entered its largest recession in 80 years and, well, looked to do what they had always done: spend their way out of it. First, the government passed the Emergency Economic Stabilization Act, spending $700 billion bailing out falling banks. Then came the American Recovery and Reinvestment Act. This time it was $831 billion, funding tax cuts, infrastructure projects, and direct relief to struggling Americans. These measures helped stabilize the economy, but they weren't cheap, and honestly, they were all put on the country's credit card. From 2008 to 2020, the country's debt increased by more than 30%, and by 2020, each citizen in the United States owed approximately $80,000 in government debt. But here's the thing, this was the era of free money. At the time, interest rates on US debt were nearly zero, meaning the cost of borrowing on all of this was practically nothing. This was all thanks to the US's reputation as a financial safe haven. Countries and institutions alike were desperate to put their savings in the hands of the US government, driving down interest rates in the process. So, despite taking on trillions of dollars in new debt, thanks to the low interest rates, it was all just about manageable. Of course, this is a strategy that does come with risks. A rise in interest rates by just 1% would cost the government an extra $280 billion every year. But this wasn't the only danger. If foreigners suddenly lost confidence in the dollar and started dumping US debt, It could trigger a sell-off that would send the currency crashing, unleashing an inflationary crisis. But in the eyes of nearly everyone, the US was in good shape, and nobody would foresee a potential crisis to derail them. Unfortunately for them, this was the very year that COVID hit, and once again, the government knew it had only one option to prevent total economic collapse: massive spending. And that's exactly what they did. Trillions of dollars were once again pumped into the economy in record time. Stimulus checks, business bailouts, and unemployment benefits. By the time the dust had settled, the US national debt had increased by more than $5 trillion. An extra $15,000 per person, added in just a few short years. After the pandemic, America's debt stood at $31 trillion. This was the first time since World War II that the country had owed more than 100% of its GDP. What had once seemed like a manageable burden was quickly growing out of control, and remember that the entire market was built around one assumption: the US dollar was rock solid, the safest asset around. That's why countries around the world entrusted their savings in the first place. But, with such huge amounts of debt, investors were beginning to question whether America could ever actually pay it back. Just 1 year on from the pandemic, China, the biggest holder of US debt, had cut over a quarter of all of its holdings, working out to $340 billion worth of US bonds. Next was Japan, the second biggest holder, selling around $200 billion. And in recent months, even the closest allies of the US, like the UK and Canada, have begun to sell. Trust in the US dollar has clearly been shaken. But this isn't the first time that sell-offs have happened, and America has always managed to pull through. But what if this time it's different? What if the US has simply taken on too much debt, and investors are beginning to panic? The first sign of trouble would be a surge in debt interest rates. The government already pays $3 billion every day just to cover the interest, the highest level in the country's history, and if the debt sell-off continues, this will only get worse. Over the next 10 years, interest payments alone are projected to cost each American citizen over $40,000. Money that could have been directed towards healthcare, Social Security, and tax cuts is instead being shipped to foreign governments and institutions around the world. The US has the largest military budget in the world, but now even that is smaller than the interest paid on its national debt. In the developed world, this is totally unprecedented. The US currently spends 18% of its tax revenue just on interest payments, almost double that of any other G7 nation. While countries like France and the UK keep their debt servicing costs to below 10%, the US is burning nearly 1 out of every 5 tax dollars. Even Greece, a country not exactly known for its financial stability, only spends about 5% of its tax revenue servicing debt. As confidence in the US dollar continues to fall, this burden is only going to grow. It's not just the government that would be in trouble. A US debt crisis would threaten the return of the phenomenon that caused the panic in the first place: inflation. Remember, when investors buy US debt, they need to pay using dollars. And it's simple supply and demand that when buyers rush in demand, and therefore the price of the dollar would increase, strengthening America's currency. But of course, in the case of a massive sell-off, the opposite is true. Foreign investors dumping US Treasury bills wouldn't just be selling bonds, they would also be selling off US dollars for other currencies. With more dollars flooding the market and fewer buyers, the value inevitably takes a hit. And this is where the real trouble begins. America relies heavily on imports. In total, consumers import $4 trillion worth of goods every year. That's a quarter of the country's manufactured goods, and a fifth of the country's total food consumption. So, as the dollar loses value, imports become more expensive. Everyday essentials like fuel, groceries, and electronics all end up costing more. And suddenly the very thing that made the US economy so strong, cheap credit, is becoming its biggest vulnerability. While all of this may seem very far-fetched, there are examples from history that paint a worrying tale. And even though it's not on the same scale, there was a similar case around 20 years ago. At the turn of the century, Venezuela was the richest country in South America. Fueled by vast oil reserves, the nation seemed unstoppable, its economy booming and its government flushed with cash. But behind the scenes, Venezuela was becoming dangerously dependent on oil exports. The country borrowed billions, a strategy that worked, but only as long as investors remained confident and oil kept flowing. Then the oil stopped, prices collapsed, and with them investor faith. Almost overnight, Venezuelan debt was dumped, the currency plummeted and the economy unraveled. Inflation spiraled out of control and people had to carry bags of cash just to buy bread. Almost 20 years later, inflation is still over 100%, and Venezuela has gone from riches to ruin. As devastating as this collapse was, a similar crisis in the US would be something else entirely. The stakes are exponentially higher. The US isn't just another economy. It's the backbone of global finance, and it could bring the entire system to its knees. For almost a century, the US dollar has been the reserve country of the world. The pound, the euro, the yen are all backed up by dollars. The logic behind this is simple. If investors lose confidence in your own country's currency, the government could use their dollars to buy back the currency from these investors, propping up the value of their own currency and stopping a financial crash. This only works if people trust the dollar. The second they don't, then those reserves backing up the currencies would essentially become worthless. It's worth noting that these things don't happen overnight, and the dollar suddenly won't become worthless. But over time, trust in the American system and its economy will fade. Tariffs, inflation, and endlessly rising debt are rapidly eroding that trust as we speak. And other countries are already starting to hedge their bets. China is aggressively pushing the yuan to be the new global currency. And some countries are already trading in gold, euros, or even digital currencies in an attempt to reduce their reliance on the dollar. The rise of competing reserves could potentially weaken America's financial dominance, shifting power in ways we haven't seen in a century. All of this raises the question, can anything be done to save America's position in the global financial system? There are basically two options for the United States, neither of which are very attractive. The first is to cut spending. By doing so, the government could cut down the national debt and reduce the cost of interest repayments. The problem is, cutting spending is politically extremely hard. Politicians win elections on promises to improve government services and cut taxes, not cut government expenditure. Unsurprisingly, since the 1980s, there has only been 4 years in which the US government ran a budget surplus, and all the other years, the government was adding to the country's debt. Elon Musk's Doge initiative has been touted as a step forward to improving this, aiming to curb wasteful government spending. But despite all the hype, the department is estimated to have saved only around $40 billion US in March 2025. That might sound like a lot, but it only covers around 10 days of interest payments. Even their ambitious target of saving $1 trillion would only cover debt interest payments for 1 year. If America really wants to tackle its crisis, it's going to have to make some brutal decisions, ones that go way beyond cutting a few government offices. The unfortunate reality is that most federal spending isn't on bureaucracy. It's on big ticket items, welfare programs, Social Security, healthcare, the military. Without cutting into these, any attempt to rein the deficit is bound to fail. However, the current administration seems to be more interested in pushing through tax cuts, bound to only make the crisis worse. This leaves the US with only one choice: printing money. The Federal Reserve has the power to create an unlimited supply of dollars, meaning the government could in theory print its way out of a debt crisis. But if America's reputation as a financial safe haven is already bruised, this would be the equivalent of economic suicide. Investors bought US debt under the assumption that it was a rock-solid store of value, one of the safest assets in the world. But with the government already printing money, having printed huge sums of money, this trust would be eroded. The dollar would start losing value rapidly. Inflation would skyrocket and foreign creditors would dump US bonds en masse, driving borrowing costs yet again through the roof. This wouldn't just be a crisis, it would be a full-scale financial collapse. The US would effectively be rug-pulling every investor, both foreign and domestic, who ever put faith in their debt. Evidently, neither option is very attractive, but either way, the debt crisis is a reality that the country cannot escape, and the government is running out of options. While cutting spending may be politically strenuous, as it stands, it seems like the only way to prevent a full-blown economic crisis. Of course, only time will tell what is in store for the American economy. Will they find a way to regain control, reduce its deficits, and restore confidence? Or are we witnessing the beginning of the end of the dollar's reign as the world's financial safe haven? One thing is for certain: without real action, this debt crisis will be catastrophic for the American economy. And if nothing changes, the consequences could reshape the world in ways we've never seen. While this may seem like a purely financial issue, it's part of something much larger. America's debt crisis is exposing just how vulnerable the country has become, not just economically, but strategically. The reliance on foreign powers like China doesn't just stop at finance. It runs deep into the supply chains that power America's defense, energy, and tech sectors. One of the most critical of these is rare earth minerals, resources the U.S. barely produces at home. Tungsten, for example, is essential for everything from military-grade ammunition to aerospace tech, and there are currently no operating tungsten mines in the United States. China holds a near monopoly on the global supply, and recent export restrictions have shown just how fragile the balance really is. Major policy shifts are now underway, and Trump's unleashing American Energy Executive Order was one of the first big moves to change this, aiming to position the U.S. as a leading producer of rare earths and reduce reliance on foreign powers. And for those paying attention, this moment could be a huge turning point. American Tungsten Corp., the U.S. ticker DMRF, could become one of the first tungsten producers on U.S. soil after a full decade of no tungsten mining whatsoever domestically. It is the sponsor of today's video, and I believe that you must research it as soon as you can. Due to the complete meltdown in risk assets over the last 2 months, DMRF stock is down 63%, which is the reason that I'm bringing it to your attention right now. The potential is that there are 0 operational mines on U.S. soil, and China has already made export bans. China has achieved control of approximately 70% of global rare earth production and 85 to 90% of the processing capacity, creating a strategic chokehold on global supply chains. American Tungsten is advancing a significant North American pass, producing mine in a region with minimal environmental and regulatory barriers compared to overseas competitors. Located in Idaho, the company's flagship asset used to be the 5th largest operational tungsten mine in the USA when it was in operation decades ago, pointing to its potential in real time. The U.S. Department of Energy classifies tungsten as a critical material. It has the highest melting point of any metal, making it indispensable for applications that require high heat resistance, durability, and strength. The company wishes to secure strategic partnerships with the U.S. Department of Defense and Department of Energy. We all understand that Trump's administration's executive orders on rare earth mean that American Tungsten Corp. is worth doing homework on, and it just announced a new CEO last week.